This conference will now be recorded.
Hi everyone, it's Patrick from the Adamus Principle. Welcome. It is the 14th of October and we have Beat in the house. Hi Beat.
Hi Patrick, how are you doing?
I'm very well. Thank you very much. Thanks for joining us. We've got a lot to go through today, so I will kick in. The topics in this evening's my position. I think we just both. I don't know if you, if you're new to the show and you don't know what we're about. We have a number of topics, and we just talk about markets. We talk about macro. Beat does his thing, I do my thing, and we just we have a rough guide with the topics. But there's certain things that really either get our goat. We feel that is the current market narrative, or big risk events that are coming up in the markets just to be aware of. So if you're institutional and you follow us, that's great. If you're retail and you're learning some stuff, that's even better. But it's just to give us both a chance to air our views, really. And the first topic we've got is risk. And I just, I want to hand that over to you immediately, Beat, because we've both been in a lot of communication with certain people on LinkedIn, and we just want to. You wrote a really good piece, and I put a little comment on there, and I just feel, you're in a really good position to say something just about risk, because you've been at a couple of, well, more than two major seats at tables, and so just tell our retail traders, because if you're institutional, we don't need to tell you this, right? But if you're retail and you don't know much about risk, or you don't think you should have stops or whatever, just fill us in.
Yeah, I mean, generally speaking, there's like we just discussed in the last few days, that the sort of topic about stop losses, yes or no, or there is the sort of debate among some people why they don't use stop losses, which actually I don't really fully understand. But anyway, reality is, if you start at institutional level, no matter how big a bank is, no matter how big of a shop you work for, you work with stop losses. You are given a loss limit as a trader that says, your manager's going to tell you you can lose X on the day. Then you shout, give me a shout. Then we decide whether to sort of close the risk or, give you a sort of another lifeline on the day. You obviously work with whether this be monthly stop loss limits, yearly stop loss limits, and the other side of that coin is your budget, right? And it's quite clearly the only way to manage risk is, whether that be on the institutional level or on the retail level. You don't want to be just knocked out in a week. You start to trade with X amount of money. You have to have a plan that you set out, where you fully understand, this is the amount of risk I want to lose. You have to come up with some sort of a real structure with a plan, and that includes stop losses, because end of the day, the key mistake in retail is that people run bad positions too long, take the stop losses too late. On the flip side, they take profits very quickly. So that is a negative P&L curve that will sort of break your bank very quickly. So the word stop loss, it seems some people feel ashamed to use it. They feel like stop loss has to do with you have to admit that you're wrong. We're all wrong. We're always wrong. And I mean, always as in, time and time again. But reality is, it is the risk management that, the way you manage a loss trade versus or a trade that doesn't work versus a good trade is what creates a positive P&L curve. Yeah, hopefully out of 5 trades, we make 3 good ones, rather than 5 bad ones. But if someone tells you they never lose, it's a lie. I have worked with some of the best traders in the world. They make losses, they get the market wrong. It's about to admit, okay, you know what, that didn't work, boom, stopped out, focus on the next trade. So people, there's a few out there, I don't think too many, that claim they're not using stop losses. So how, A, do you manage your money? Or if you take client money, how do you look after your client? You can't just go like someone gives you money to trade and you turn around and say, oh, sorry, mate, lost it all, didn't have a stop. I don't understand how this can work. So reality is, whether retail or specifically retail, you've got to have a plan. You have to have your stops in place. So you know what you're losing on the day in order to, get it through 3-6 months of trading. That is enough time to start to realize whether you're, how well you're doing or if you need outside help. But definitely don't want to blow up in a week, which you could easily do if you don't have a stop loss, right?
Absolutely, absolutely. And thanks for those wise words. I mean, my take on stop losses is, I think I commented on your LinkedIn post is, ask Paulson, ask Bill Ackman about Herbalife and stop losses.
Yeah.
He lost a yard on that to Carl Icahn. Yeah. So, but he's doing really well now. He's still got skin in the game, and he's turned stuff back. But he's got deep pockets. He was wrong. Paulson was wrong on gold, right? He's huge. He's like one of the biggest hedge fund managers in the world. He was really wrong on gold. Subprime, he was properly right, but this is all part and parcel. And the guy, one of the big guys, Adam, my business partner, he kind of introduced me to Spot, and Serge, who kind of tutored me as well. He ran G10 at HSBC. He's one of the best traders there is. I've met in Spot, and he said to me, he had a 35% hit rate.
Yeah.
He never looked at taking profit. He only got stopped out on positive, and that sometimes he would do that, and he stayed in his trades for almost ever. And that was his style. It's not always applicable, but in some markets you can do that, and the moves you get, the risk rewards are, 5 to 1.
And end of the day, like we say, it's about affordability. So if someone has deep pockets, okay, he has a 2% stop, 3% stop. So the amount of stop doesn't matter as long as you manage your risk. If you have deep pockets and big plans, if you take profit is 10%, your stop loss might be 3%. If you're looking to make 40 pips, your stop loss has to be 15 pips. So somewhere you have to have it in the sort of relation to what you're playing on the other side, and how much your account can actually take, right? So, retail that starts in the game with a small account, yes, you can't afford to lose too much, because if you lose a few times in a row, you're done. So you have to have a different plan. But again, it all comes down to what you set out to do, how much you can, realistically lose, and then start to work around that. The rest, as you say, it's like, different ball game. And macro guys have a stop somewhere, whether that is a pure level, a percentage level, or when the story just really goes wrong. There's no one I know that just sits there, something goes 20% against him, and he goes like, yeah, I might bounce sometime. It's just, and like you pointed out a few cases, I pointed out, take Euro Swiss, for example.
Yeah.
Right. So if you just think like, I don't need a stop, well, good luck. You're still waiting 3 years on.
Yeah.
And not to speak of, you would have lost, well, if you were leveraged, you lost everything very quickly. If you weren't leveraged, you still lost 50%. So, I don't know. Or take 2008 yen cross. No matter what, equities, dollar yen. Sorry, but I just cannot see how someone just can say, I'm not losing a stop, because some stuff doesn't come back, or it doesn't come back for a long time.
That's right. That's right. I mean, I remember trading Eurodollar around 103, 104, and everyone was talking about parity, right? Yeah. Good luck with that. Right. If you're still short at 104,
it's 125
all the way up to 20s, and then it may never get there ever.
No, you're right.
Like, you know what I mean? Then everyone's talking about parity at the time. Like, King dollar.
But there's just no excuse, no matter what kind of underlying you play. It doesn't matter which asset class, Doesn't matter how macro you are. At some point, an idea might be wrong, and you have to live up to it and just say, okay,
Yeah,
it just
and
doesn't work, right?
and absolutely. And the thing is, like, we've been around a while, and you much longer than myself, and it's like, just swallow your pride. Why do you always have to be right? Just and don't have a, if you're retail and if you're say you're trading lots, or say 100,000, and you've got 10K, I wouldn't recommend you trading more than 2 lots
Yeah,
max.
yeah,
For now, just to get your way, maybe just 1 lot or 100,000. That's just
yeah,
my kind of thing. Because I always say, if you're trading and you pull the trigger and you've got your stop in and you're sweating and you're nervous, it's too much risk. You've got to think, with one of 1,000 trades, you've got to be comfortable, and you accept your risk, which is basically stop. And when you define and accept your risk, then there's no fear, because you know that your ultimately your approximate risk reward will come good, if you're consistent in that kind of approach. But you've got to know where, when I was doing futures, when I was trading bunds, first thing, where are you wrong, Patrick? Where are you wrong? Okay, I'm wrong here. I'm wrong above there. I'm like euro dollar. I'm wrong above 116.20. Right? That's where I'm wrong. I'm selling into that.
to be honest, I
If
think
come on, that's the thing.
it's the plan. For me, the experience I made is just, before I enter a trade, I know exactly where my stop loss is. I have a rough idea what my target is, but on the target side, I'm kind of flexible, because what starts off as a short-term trade could suddenly become a medium-term trade. So I want to keep that option open. But on the downside, it's clear, that's a level, that's where I'm wrong. It's going to cost me that much. And that actually, if it's a high conviction trade, I can be stopped and have no emotions. Why? It was a plan. That's my view. It's a high conviction trade. That's why I'm wrong. And if I get stopped, I just say, okay, I was wrong. I don't even blink. And I
Yeah,
swear to God that is true. I just look at the next thing. The only stops that really get on my nerves would be when I have a sort of low conviction trade, fooling around in the market, already know I shouldn't be trading because I don't really know what I'm doing. Those are but they're harder to take for a different reason, because I just know I was stupid.
yeah,
I shouldn't have
yeah,
been doing. But if you have a plan, it actually can add to your kind of how you feel, because you have a plan, you execute your plan, you discipline stick to the plan, especially to the stop loss. And you know what? If you hit your stop, okay, there's a next opportunity there. You were just wrong, and I just usually just move on. It doesn't affect me at all, because you have a plan, and I stick to the plan. And you know what? Like you said, I'm doing this for nearly 35 years, and I still work with a stop loss, and I don't feel ashamed to say I was wrong. And I think that is probably the key. Like I say to some of the students, it's mirror talk. Look in the mirror, look at what you see, and you have to be honest with what you see. We all would look like, love to look like more muscly, or like more like this or that. But reality is, you have to be true to yourself. Don't lie to yourself. Don't try to fool yourself. You're
mm.
wrong. Okay, next thing.
No, you're absolutely right. Couple of points on stops as well is, first of all, have them, be comfortable with your stop, and you know, as a retail trader, don't add to your loss. Don't have a massive wide stop and double down. The other thing, there's a cross between averaging in or layering in, which sometimes I do, but like, say a market's broken, I missed the break, I'm selling or buying at market. But I do that because I know that I can work out the overall risk involved, and I start really small, and I'm
Yeah,
comfortable with that. But lumping in any kind of size at market and then adding to it, you're going to be uh, you're going to
yeah,
be in a lot of pain if it goes
trouble.
you. So that's really important. Just to say, it would be great if any of our followers chip in, add your own views, especially institutionals, because if you are retail, you need to stop. That's it. And you're talking to two institutional traders. I've been on buy side in hedge funds and prop desk, and Beat's done both. He's done sell side, he's done spot at UBS. He's also been on the prop side at Goldman. So you got it right. That's it. That's over. There's no question. We did invite this particular person onto the show, but he didn't want to come. That's fine too. Okay, if you want to come on next week, you're more than welcome. Just to explain your corner. Maybe we've both missed something. Hey, who knows? But if you have any more comments, just let us know on that. So the next thing I want to talk about, B, is King Dollar ? There's a couple of things that I've picked up on. I just think I had tons and tons. 2-3 weeks ago, I had a massive long list of things about CPI spiking. There's wages on an uptick. You've got yield spiking. You've got a massive budget of 90, quite a lot, like 90 yards or whatever it was through September in the US. Loads of those reasons. Now, 2 months ago, CPI from the BLS 2.9. Now it's 2.3 headline. Core 2.4 2 months ago, and now it's 2.2. Incidentally, core was unchanged last week. The mean, I've done a little bit because I'm a futures guy and I like market profile and mean reversion. I've done the mean. I've basically added up all of the CPIs in the year and divided it into 12 and got 2.4. And now it's 2.3. So I just think there's a couple of talking about CPI. There's a couple of things. I spoke to an inflation strategist from One River Management, Lindsay Polity. She incidentally used to be a portfolio manager for Tudor, so she's properly got strike. She knows what's what, and we discussed loads of things. I was saying, look, she told me about 2 reports she's published, so check them out. If you want links, we can send you them. But basically, just talking about CPI and where's it going, or what are the effects. Oil's obviously rallying, and that has a massive effect too. But it's a problem at the moment. Unless it stabilizes in the US, it's going to be a real problem, because not only that, you've got Sears collapsing. You've got Trump calling the Fed loco. I mean, that's nothing new, right? But all of it together, and two big misses on CPI, is going to raise a lot of eyebrows. What do you reckon?
Yeah, to be honest, I mean, I feel almost like deja vu from a month ago when we done that on Sunday after the last CPI miss, and I have the same position as a month ago, which is long euro or short some dollars again. It's bizarre, and every time you're like in a sort of different kind of situation. Now, it's just about, I would think the dollar would have sold off more were it not for the sort of stock market wobble we had, which obviously keeps some dollar beats, the likes like the risk-off dollars like Aussie, Canada, the commodity block. So it's very hard, obviously, for the dollar to really know where it wants to go. And you could definitely see that in the euro. We had a quick sneaky peak above 116, but we didn't manage to sort of hold to the gains. Why? Because of euro yen, and the stock sort of wobble. The one big thing, the Sears incident, even though it was probably the reason stocks collapsed that day, 800 points in the Dow. But it's really, like we talked about, it's more like the sort of straw on the camel's back, that broke the camel's back, rather than Sears was in trouble for years. But we have ignored a lot of the facts in the last few months. High yields, We ignored that in the stock market. We never really had a correction based on the trade war escalation. So the reasons for a lower stock market has just added up and added up and added up. And at the end, as so often, you just get one headline that usually in itself is absolutely no story, and the whole thing falls apart. Now, the key now is this just the sort of wobble again that we had a lot of times in 2018? Or because we all kind of bearish somehow, right? Since many months, we know the stock's gonna turn at some point because of this, that, and that. And now it's happening. And somehow I'm so brainwashed from 2018 that every dip just came right back that I'm really uncertain at this stage. The one thing I would say is we start to get to know Fed's Powell a lot more. And we knew that Greenspan looked after stocks, we knew Bernanke looked after stocks, and we knew Yellen looked after stocks. And it looks like Powell will not look after stocks in a way that we would expect it to be, right?
Yeah.
Or I would say it's now mid of October, the deck hike is still firmly priced or expected, even though, you know, expectation may have reduced a little bit after the CPI miss, but I don't think anyone is out there that would already call, you know, for a pause in December. So the Fed speaker is going to be important in the next few weeks, just to see, you know, they still mainly talk pretty hawkish to me, you know, even Evans, that is kind of a more in the dovish camp, sort of made a few points about, you know, yeah, we have to hike and blah 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 blah. So, you know, the message is not there yet that the CPI miss is causing him many worries, the trade war doesn't cause him many worries, and Trump will just be point blank ignored, because I don't think there's any risk of the Fed losing its independence. What I don't know is whether Trump gets so upset after the December hike that he just fires Powell. I have no idea if that's actually really possible or not, or if he just said that. That's the only total unknown, something we never had since we're in the market, that you have such a situation that actually, if Trump gets just fed up with the rate hikes, he just fires Powell. I can't see it, but you know,
is this can he do that so quick? I mean, I don't know if
I don't know. To be honest, I'm absolutely no idea. Given the changes in
the man, he chose him.
Yeah, so whether he chooses him and then he gets nominated and it goes through, I would say the House has something to say, because he had to be approved by the House, didn't he? It's not just Trump picks him, then he puts him in front of whatever committee there is, then they vote for him and accept him, blah blah blah. So I couldn't see that Trump just can send a letter and say you're fired. I would be really surprised. But you know what? If he keeps on just going on about it, maybe there's a point where Powell just says, you know what, can't be bothered. But I don't think we're anywhere near that. So I think the key question is, for me, I'm keeping a small dollar short with a stop loss that is not too far away, just to see whether the dollar has a chance now this time around to weaken. Last time, if you remember, shortly after the CPI miss, euro goes from 116 to 118. We had Italy. And we never quite knew, is the move back down in the euro is Italy? Yes, then it was Italy. And just when the euro was already like 200 points lower, we got a big move in the bond market, and then the dollar started to go a bit. So it was a very complicated move, which I don't think I was able to really fully understand the true message. That, you know, I've seen 200 pips for Italy, and I saw like 80 pips for the dollar, really, in that sense. And then again, euro did not want to stay below 115. Fact, you know, we can scream and shout about, but we got to 114.30 and we 115.50 again. So yet again, we didn't stay down. We talked about dollar CNH. There was a massive sell-off on Thursday, 694 to 687. I mean, in a day, we don't see that very often in that pair. And gold exploded. So you had all the ingredients for the dollar to actually start to come off. And the big break in gold, not that I watch gold very often, but I had a you know, this 12-12 level was just a sort of range top for quite a few months that,
Yeah.
you know, I always thought like if that breaks, then something is changing. And when you see these type of moves, which make no sense on CPI day, you would not expect gold to rally 3% if we have a CPI miss. It makes no sense. That has to be a dollar message. And just, you know, I don't think we have a clear trend. I think we're going to go sideways for quite a while longer. The dollar to me, given that I was like bullish most of the last 10 months, I'm not feeling it anymore. You know, yes, I was quickly bullish for a week again, but I struggle to get back into the same feeling I had most of 2018. And I can't actually put the finger on it. Is it just price action? That the euro just resists, no matter what we threw at it? It just resists to stay down there. So at some point, we're going to get news that's going to challenge the top side. But, you know, euro dollar is complicated when it's risk on, risk off. So if stocks collapse, if dollar yen collapses, euro dollar goes up. If dollar yen sneaks slowly, euro dollar can come off with euro yen. So there's no, so maybe we have to keep an eye around risk more than we do on euro dollar. Euro dollar is maybe just too complicated right now, if I'm honest.
Yeah. I think, you know, I think I blogged a few times. We're still in risk flows. We're in the middle of the risk flows, and they take charge at the moment. It's I think the other thing I did I on the CNN thing, I've been in touch with Jens Nordvik, and I know you guys know each other. Yeah, a really lovely guy, and we were just talking about the seven, and you know, and I obviously I got that from you, and I put it to him, and I said, look, do you see seven going on dollar CNH? And I think what I got was it was a very strong hint that eventually it could very well go, but that would obviously mean China changing its policy. Because they'd have to rethink, as you said, I think it was last week, saying that you've got a trade-off between a really strong dollar and then them spending, you know, an arm and a fist defending that bottom peg.
To be honest, I would agree. It's a break of seven would be a policy decision when they say or when they feel that the CNH or the CNY has to weaken further as a monetary policy instrument, rather than it being seen as a devaluation on the back of the tariffs, and then you have the US back on your back. The interesting thing, maybe if you just speak China, is I think the Treasury report is out on Monday. I think we already kind of know from last week that China will not be named a manipulator. So, you know, I can't remember if it's once a year that this list gets written or if it's twice a year. It's definitely once a year. So we maybe keep an eye on dollar CNH next week. Once the manipulator list is written, where they're not a manipulator, whether or not that move down in dollar CNH last week has been a little bit of a politically inspired move, as in not being the spotlight. Because you know what, it's the same as Japan. You know, yes, I know it's silly, and people that may not have been in the market for a long time maybe think I'm just going crazy. Reality is, back in the days when Japan always kind of devalued the yen a little bit, whenever the US Treasury Secretary would travel to Japan, Japan always made sure that the yen got a little bit stronger while he was there. It's just, you know, and I wouldn't be surprised if that big sell-off in dollar CNH last week was one of these kind of, oh, let's make sure we're not like in the spotlight of the US, because you know what, no matter how they go about things on the trade war, China doesn't want to be too confrontational. Not that I fear the US or whatever, but I think so far they've been the clever guys in this trade war by dealing with a lot of other people, making a lot of new deals in Africa and elsewhere with Europe. They almost be seen as the more rational thinkers than the US. So it's almost like the bad boy is almost like the US, and China's doing all the right things. I don't think they escalate anything. They don't try to be like provocative. And so that's why I think for the time being, I think they're going to play bold. I think they have more to lose if they let 7 go too quickly. China stocks, if stocks are already soft, if 7 goes, the Chinese stock market just going to go, south so hard. And I don't think it's counterproductive. I think they hurt the economy more than the benefit of a weaker currency at this stage. Like probably Yen says, that might change in 3 months, 6 months, 12 months, who knows? I don't think it's in the near term. I really don't think so.
Yeah, 113 will go on euro dollar if 7 goes. That's my humble opinion.
Yeah, exactly. I totally agree with that. Totally agree.
The other thing is, that's an interesting move. The other thing is that their US debt is about 1.2 trillion, I think, at the moment. I may be wrong, but that's what I picked up on. Do you ever see them selling any treasuries? And if so, do you agree with Munch in saying that they'll get picked up in the most liquid market in the world, riskless kind of assets? So there's a bit of that, if they do start dumping big bucket loads of that 1.2 trillion,
to be honest,
get a big old spike on yields.
I think it's absolutely no way. 2 things. A, China is very, very smart in terms of how they invest, how they go into stuff, out of stuff. They're very greedy type of, they're not gonna start dumping treasuries, losing like a carload of money, because they know if they just dump whatever they're gonna dump, they're gonna get a move, they're gonna lose money. They have no interest to do that. Then don't forget the other side, and I've seen these people, these guys, for various banks that I worked with, so I see how they operate a little bit. There's just no liquidity. Yeah, you can pump a lot in the euro. That's the second biggest market, but that's it, right? I've seen, the investment programs from some of these guys that go a little bit into Norway, a little bit into Sweden, a little bit here, a little bit there, but that's like a drop in the ocean compared to their reserves. They have no other choice, right? Well, do they sell some of that? Yes, because they go like, okay, the US is in this cycle, that's what's happening. They are not just, they adjust their portfolio according to their expectation of the market, like we do. So they're not, blind to the market. So if there's a small shift needed from the US dollar or from US assets into euro assets, or there's a fine tuning gonna happen. Are they just gonna weaponize their bond portfolio? Never. I cannot see that happen. Yes, shift. Yes, I think they've been selling this year. I definitely think so, but not in a way of punishing the US or trying to create whatever they want to create, because again, they cut into their own sort of flesh. If they were to weaponize a bond, you get like 10-year up to 350 in a hurry, stock's just gonna collapse. Like that's just the costs of this. It makes no sense. So I think, I saw the article. It was in the New York Times, and then Zero Hedge picked up on it. It's a valid question, definitely. But I just cannot see. This is not the first time. It happened in the past. I think this topic came up about 10 times the last many, many years. And I still don't think they're gonna do that. So I'm not worried about that side. What was written about last week, which not many people may have picked up, the Japanese sold a lot of treasuries apparently.
Okay.
So I'm not sure, but this is, we're talking about the not the BOJ or the MOF. We talk about corporate Japan.
Okay.
Why that is, I'm not sure, but that was just some. And I remember when I saw it, and I go like, maybe I was wrong. Maybe I was wrong on the Chinese selling. Maybe it was the Japanese, but I didn't really see what the rationale is why they'd be selling U.S. treasuries. But who knows? I think it's a tough call when you don't see the sort of flow firsthand.
Because of course I forget, if you're real money or pension funds or big juggernauts, by almost law, you have to hold a certain amount of bonds.
Yes.
just keep that kind of risk in your
Yeah.
VAR models, and you have to, and that there's only a certain amount of bonds around from your own country.
Yeah. And you know, very often, as you know, is they can just shift. Okay, I go from that much percentage to that much percentage, but I only always going to have a certain amount that I just have to keep. No, that's why I think, you know, it's very easy to talk about weaponizing, you know, bonds or whatever. I just don't think we're at the point. Could we ever get to the point? Yes, we could, but I think relationship between the US and China, or the US and other countries, has to get a lot worse. You know, I think we would know when there's a risk. Let's put it this way. I think relationships would have to go sour a lot more, you know, and we would know when the risks are increasing. But I just don't see it.
Okay, mate, that sounds great. Just we'll go through the markets now. Euro dollar, we mentioned 116 sort of 20. I mean, I like 116 10 20 or whatever. Happy to, I might be selling up there, but I just see this cluster here needs to defend. I mean, I think I'm long into the weekend around 50. I think it was around that area. And I think we were talking off camera before. I think we're going to open around 30s, but as long as we stay above that kind of 115.20 area, I think we can just expect some more ranging. What are your thoughts on euro dollar, Pete?
Yeah, to be honest, I keep it simple. I have a stop loss at 115.20. That would bring us back below this whole 30-50, you know, cluster that we had. And it's really about the conviction side. You know, I felt strongly that the dollar could weaken after the CPI miss, which it did. But the way euro came back down, I just go like, you know what, conviction is just too low to spend much money. So if you break below 115.20, I think I step aside from euro dollar. Euro dollar is just gone sideways for so many months that maybe it's just time to just step aside again and just wait, you know, look at other stuff. So very tight stop. But if you hold the level, I could see a challenge against 16 and a quarter, which for me, 16 and a quarter is the gate opener. I think then we're going to challenge a 117, 117.50. Whether we get momentum, get a move, or if it's just 15.18 like we had for the last 3 months, it's too early to say. But I would say 15 and a quarter, 16 and a quarter is the range to start the week. And a break either side gets us the move. Break 15.25 is a failure. 16.25 would be the accelerator. Worst case, just stay inside that range, which we don't have any real news. Well, we had last week and we missed to move. So either, you know, the market wasn't willing to move back end of last week and we get the move this week. That's maybe the only hope I had. You know, Monday, Tuesday, the market goes, you know what, okay, what did we get? We waited for CPI for a long time, another miss. And then suddenly a story develops, but because it should do. You know, October is the time when you get the sort of year-end moves, right? The kind of last push of 2018. And I just can't see us like drifting around another 3 months, 4 months.
Yeah, and also, you know, when I was in the pits, I always used to find October was like the big guys putting the stake in the ground again. This is my position, you know, or a new narrative taking shape, and everyone's like, okay, it's going to be a yield course, so it's going to be it's going to be wages, it's going to or whatever it is, you know. And I've just drawn a fib from there. And you talked about 116 and a quarter. Well, that's 20s is 50%, and then you've got the 100-day moving average, which is 27. So all of that area is the midpoint. It's just a very nice kind of, you know. It also, you know, this area here, it also suits this volume here really nicely. It's mid-range. It's safe, it's, you know, so I just see that completely makes sense to me. So the other one is, let's touch on Brexit, not too much because, you know, this could all. I can't. I can't do cable anymore. I've been I've been hurt, been upset and hurt, and she's a very unreliable lady, as you know, and not as maybe the Looney or maybe Dollar Cats are pretty close up there, but cable is unreliable. But yeah, we had some reports coming out the weekend, which you blogged on your LinkedIn feed.
Yeah.
And it's going to be what the Open. Do you think it's going to be a disappointment?
To be honest, I mean, we had the story of a deal, and that's why I sort of was blogging, sort of warning people that yes, that might be the EU handing the UK a deal, and the market might get a euphoric on the Open just to figure out, well, it's been an offer, but doesn't mean it gets accepted. But the story has already turned before the Open, where it's now said that the Brexit talks hit stalemate in Brussels as we speak. So this so-called, there's a deal on Sunday and it'll be voted on Monday, is already out of the window, which probably means they're going to sit down together all night. So cable came down to, it's now 130, you're just dealing 131. So it's down about 40, 50 points on the disappointment.
Yeah.
One thing which I was blogging as well, and that's something I feel strongly about, is, I'm not a, political expert or whatever, other than, I feel strongly about stuff from a market perspective. But I think the risk has shifted from Brussels to Westminster.
Yeah.
I think it's a bigger risk that Europe makes an offer and the UK rejects it. Not as in, it's more like by accident, whether the DUP suddenly withdraw the support for Theresa, whether the Brexiteers like David Davis is calling for a revolt. So I think there's a real chance that UK infighting politics screws up whatever there is on the table. And so I no longer think the risk is in Brussels. I think there's a risk in Westminster that this just goes wrong by accident. And we talked a lot about it. Sterling has been bid on dip because people probably realize, or actually just feel like, what, no one can be that stupid just to walk away because the damage is just too big. So people assume there'll be a deal, and most likely there will be some sort of a deal. But the one thing I'm not sure is if we're gonna have one more big hiccup. Whether we go straight to a deal, as they said, today, tomorrow, or this week, or if just a political infighting creates one more caveat. And that's why I just don't touch cable. I just can't. I think it's very hard to manage.
Yeah.
Yes, if you get a good deal, sterling is probably undervalued. If you get a bad deal, it's probably far too high. So, you have to have some funny option structures, but they're not cheap. And it's definitely not something retail could afford. So it just means you have to be honest with yourself and just say, what, let sterling sort itself out. I think the only thing you can still do is at the key levels, if you manage tight stop loss, we had this 130, 150, 65 zone that has flip-flopped around. We keep on talking about the 130, 50 level, which has flip-flopped around a lot. So if, I wouldn't, I would still be okay to trade some of these. If cable now 131, if it gets down to 50, 60, you can easily buy in the 50s, stop below 30. There's a 25 pip stop for a chance to make a big figure or too big figure on the way up if it holds. Why not? So I don't think there's a trade where you can risk buy and hold or sell and hold. The only thing you can do with sterling is hit and run trading. There's just no point. If you can make 50, 70 points, just take it. Because they could be gone a minute later.
Yeah, exactly. Well, that's great. Dollar yen, I did pretty well out of this. I blogged, there was a little head and shoulders up here. You can see my chart on dollar yen, can't you? Yeah. And then we just broke that. I blogged about it, and then I caught quite a bit of this move. And obviously, I was just saying about luck. I was lucky because of I was on the right side of the Sears thing, and I sold that for technical reasons. Just a small note on Head and Shoulders for me as a technical trader. They don't often work, but when they do, they sometimes not only work, but you do actually get your objective, which, let's face it, is from that to that and that to that. So
yeah, it worked nicely, right?
The objective. So the only thing I'll say with dollar yen, it is a very difficult one to trade because you've got yields versus risk off.
Yeah.
You've got a bit of a tug of war, and the other thing I will add to the mix is I did an interview with Core TV, and there's a guy who gave me some charts called Greg Gibbs, really great, and he was basically looking at the curve all the way from 3 months Euro-dollar futures yields uptick, 2-year uptick, which is the big one for rates, 10-year uptick, 30-year rallied, all tick, 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 and then they had a dollar index still in range, and that was obviously over, so that as well as I, yields getting lifted left, right, and centre across the curve has only recently started to help drag the dollar up.
Yeah,
because it was never like that for a long time, right?
No,
So
just ignored more or less.
And that could just be a one-off, and we could go back to the ranging. So it's just an interesting play on dollar yen. But I don't see. I mean, if you look at the daily, let's have a look down here.
Holding it. I was looking at this 1190, 112 area, and it's kind of holding quite well for now.
Yeah, I mean that's a level for me.
But it's like you say, it's like right now it seems everywhere you look, people are like on hold because we all don't know, right? So we kind of, like you said, in dollar yen you have like the yield story, but then we have the stocks, and stocks look like they probably might actually have turned and rolling over. Now the question is, are they just grinding lower as a correction, or are they accelerating lower, creating risk off? It's really, it just feels the market doesn't know, and it's almost like everyone waits. No one wants to be first, and I think that's where we have to be careful. When suddenly stuff starts to move, we might have just to close our eyes and join, because it feels like no one wants to be first, and when it starts, it could be a stampede. It just goes, and so I'd be probably starting the week a little bit hit and run. I keep those core dollar shorts just to see whether it works or not. But other than that, I'm gonna be very hands-on in terms of trying to join whatever happens. I think it's probably.
I think, yeah.
You have to be fast on your feet, I think, next week.
Absolutely. And I think with this, the situation, we're still in the risk off on environment. I think yields have bubbled up into a new narrative. So let's see where that takes us. The only takeout I think on the yield story is stocks have taken note. That is the only thing. The dollar is not in tandem, in the lockstep, doing a tango with yields. It might form into that, but stocks have gone, hold on, guys, this is we're taking note now. FANGs, which have been looking really, really vulnerable recently, for a while actually, specifically Facebook. So eventually something's got to give, and then a big old juggernaut CS, we've all known it's been in trouble with the Amazon type new environment we're in, but still it's Sears, it's gone from Wall Street to Main Street, and you get mom and pops going, oh my god.
Well, to be honest, I mean, we see it in the UK, right? Whether say House of Fraser or some of the others. I mean, it is the Amazon effect. It's probably globalization / Amazon effect, and middle class, right? I mean, we keep on talking about when we talk about real macro stuff. I mean, long-term macro stuff. Reality is the last 10 years has nuked the middle class, right? There is no middle class. Yeah, there is maybe a small one. And you know, in the UK, they're gonna be, you know, maybe struggling in the next few years. John Lewis, you know, short like big retailers that depend on the middle class start to struggle. It started in the US. You know, Sears just its latest victim, right? Macy's struggling for years. Some, you know, probably there's a lot of names we don't even know that already gone bankrupt in the meantime. And it's coming over here. Or it started quite a while ago. You know, if you look what kind of companies are in trouble here, that is still the big question. And I think that's why, you know, I probably can count you into that camp. I'm a massive bear beyond belief that the next crisis is going to be far worse than 2008, and it's on the front door, right? Whether this is in a year's time or in 3 years, I don't know. But the next, there was a story, I think, was it today in the FT or yesterday? You know, the FTSE 100 companies, you know, the big oil companies, that their debt is the double of pre-08, right? So we are from 200 billion debts, we are at 450 billion, you know, from just some of these large FTSE companies. And that is a mirror of this entire world of where debt is now versus, you know, and people are worse off. They are, right? And we talk about job growth in the US, and reality is a lot of the new created jobs are low paid jobs. That's why probably, you know, earnings is not like going, who knows, you know, it's a very complicated topic. But, you know, on that bombshell, and that's why I'm nervous when stocks start to go off. I think yes, they come off, but I don't think it's a big one yet. And that was makes me a little bit. But if you would have put a gun to my head, I mean, the next crisis is just going to devastate everything. You know, it's going to be big. And the worry is central banks have no bullets, nor do governments, right? But that's probably too macro right now.
Yeah,
and hopefully be wrong.
Well, you know, it's going to be interesting no matter what. So, you know, that's fantastic. Thanks for your wisdom there as always. I know it's always a pleasure. Always a pleasure. So we've got some, you know, just feel if you want to comment on any of what we've said, especially about risk or any of the market news, just give us a shout on my feed. Message myself or Beat personally, and we always get back to everyone. I've got some very special news that I haven't even told Beat. So I've been in contact. This is a big news for me, with someone from the Federal Reserve. And he is called Alex Cohen. He's from the Federal Reserve Bank of New York. He's an officer. He's in charge of 8 or 9 traders on FX, and he's had a lot of experience, not just with the Fed, but with the Bank of England. And I reached out to him just to ask him if he's willing to chat. And he said yes, but obviously it's restricted. So I, along with what I do normally, if I do get an expert on, I you know, I come to some assumptions and conclusions in bullet form. I email them, they okay it, and I publish it on my blog, right? So I'm in the process of setting that up, and I don't know how that will come out. Hopefully it'll come live on the show. That'll be amazing. But if you have any questions for him, let me know. Let Beat know. You know, and you know, we'll, straight from the horse's mouth, we'll ask him. Yeah. So that's really exciting for me. A couple of events that are really good. About 23rd of October, we've got a taster, making sense of macro. It's on my feed. It's the last post I did. Beat's going to be around. I'll just be taking through all the really important bits. It's giving a little taster of the big one. And the big one is 7th of November. It's the 3-day masterclass. And we'll be teaching you how to trade. You know, Beat will be telling you all of his great experience. I'll be teaching you macro, technical, flows, positioning, news, data, along with other fundamentals. And no noise, all pith, clear as gin, straight and straight from the hip. So just finally, last but not least, Beat's got an amazing daily commentary. It's just incredible. I still get it. It's you know, it's been really popular recently. And if you're retail trader, you just need that edge, that you know, you want to turn it up a notch, and you just need a bit of reassurance. I'll pass you over to the very reassuring Beat. Over to you.
Yeah, thanks very much, Patrick. Yeah, to be honest, it's really a sort of you know, a chart package on the one hand with a little bit of you know, news, the way I see it, trade IDs, and you know, some of the emails might be almost a bit tutorial, because I think Patrick and I talked about, you know, some of the topics. You know, seems like crosses, it's something that doesn't really find a lot of headlines these days, and you know, there's a lot of, yeah, not free trades, but a lot of almost free trades if you understand something from the business. So it's something I do. You know, if you want to know more, you know, I can put you on a sort of 1 week free trial just for you to sort of snoop around. The chart has like you know, trade IDs, risk reward levels, and so on and so forth. And you know, it be for the day traders as much as for the guys that sort of trade a bit medium term. You know, speak to Patrick or myself, put you on the list for a week, and then you can decide whether it's something we should be talking about. Thanks very much, Patrick.
Thanks, Beat. And you know, it's been a great session. And yeah, have a good one in Asia. We open in half an hour. And yeah, just have a great week. And I'll be watching China's GDP. That'll be the one I'll be watching, and where that goes. But also you've got UK CPI, a bit of wages. We've got a bit of retail sales in Canada and stuff like that. So you know, enough to get your teeth into. And obviously we're getting closer to the midterms. Trump can say anything and will say anything. So it's all going to be interesting. You know, have a great week, and we will see you next week. Take care.
Bye bye, everyone.